Welcome to Success Series. Today we are going to continue with the IS16. This is the part 2 of the IS16 video. If you are now watching here, we recommend you watch the part 1, which is at the link is in the description below. You check the video description, you see the link to the part 1 there. Now in today's video we are going to look at the subsequent measurements for IS16. That's property, plants and equipment. Now let's dive into today's lesson. Now with the subsequent measurement, according to IS16, we are required to either use two methods. We first have the cost model and then the revaluation model. Now let's look at the cost model. Now with the cost model states that in ascertaining your carrying value or carrying amount, you have to get the cost of the asset, which we discussed under the initial measurement. Then you less the accumulated depreciation, and then you less the accumulated impairment. Then under the revaluation model, to ascertain your carrying value, you pick the revalued amount. That's in the case whereby an asset is being revalued at the end or being revalued from time to time. So you pick the revalued amount, then you less subsequent, here the keyword is subsequent accumulated depreciation, and then you less subsequent accumulated impairment. Now someone asks, what's the difference between the accumulated depreciation and then subsequent accumulated depreciation? Now let's dive into that one more. Now measurement of depreciation under the cost model is basically the same as using a straight line or reducing balance, mainly using a straight line and reducing balance. And if we're using a straight line, this will have been the formula. Remember this formula is cost minus the residual value, or some books also terms as scrap value, over the estimated useful life. So this is the formula for straight line. But when it comes to the revaluation model, how to get the subsequent measurement of your depreciation will be rather revalued amount over remaining useful life. So it will be revalued amount over remaining useful life. So here you have to take into consideration the number of years you have used the asset for, and then you subtract it from the total number of years to get the remaining useful life. That's the only difference, the key difference over here. Now let's dive much more into the revaluation model. Now in the revaluation model, there is a need for you to always ascertain your revaluation gain or loss. So how do you ascertain your revaluation gain or loss? Once you have revalued a property, you have to compare this revalued amount that you have gotten with the current amount, and you take note that we ascertain for revaluation gain or loss on the date of revaluation. So there is the need for you to always ascertain the current amount up to that particular date. So yeah, if the revaluation occurred at the end of a particular year, you have to find the current amount up to that particular end of the period. If the revaluation occurred at the middle of the period, you need to calculate for the current amount up to that middle of the period in order to compare to get your revaluation gain or loss. Now, to get your revaluation gain, let's look at how the treatment of revaluation gain and revaluation loss will be. Now with revaluation gain, the treatment in the financial statement, how is it treated? If it is the first time you are doing a revaluation, you are expected to send it to statement of other comprehensive income. Yeah, if it's the first time, send it to statement of other comprehensive income. Now if you also, it was the first time you are recognizing revaluation loss, the first time you need to send to profit and loss. Profit and loss. However, when we pick revaluation gain, we can send it to profit, or we must send it to profit or loss in the case whereby previous years you accounted for a revaluation loss. Therefore you need to send the revaluation gain for this year to profit or loss, not to revise the previously recorded revaluation loss of the same amount. Yeah, what does it imply? Let me use figures to make it more easier to understand. Yeah, in the case whereby previous year, let's say last year, we accounted for a revaluation loss of, let's say, 20 Ghana cedi, and in this year we had a revaluation gain of rather what, 30 Ghana cedi. We expected that in this current year we will send out of the 30, we'll send 20 to profit or loss, and then the remaining 10 will be sent to statements of other comprehensive income, that's OCI. That's how the treatment is supposed to be done. Now let's look at revaluation loss. In the case of revaluation loss, as I said, the first time treatment is supposed to go to profit or loss. But in the case whereby previous years you accounted for a revaluation gain, and therefore you had a revaluation surplus for that. When you had a revaluation gain, you accounted for a revaluation gain, you need to send the revaluation loss they have gotten to OCI to reduce the previously recognized revaluation surplus. Let me use a figure over here. So in the case whereby in this year I rather had a revaluation loss of, let's say, 40, and the revaluation gain recorded for last year was 20 Ghana cedi, I need to send out of the 40, I need to send 20 to OCI to cancel the effect of last year, and then the remaining 20 will now be sent to profit or loss. Now let's pick a question in order to make the understanding more clearer. Now question: on 1st January 2020, the fair value of Success Limited property was 400 Ghana cedi with a remaining useful life of 20 years. The company's policy is to revalue its property at each year end. At 31st December 2020, the property was valued at 344,000 Ghana cedi. The balance on the revaluation surplus at 1st January 2020 was 80,000, which relates entirely to the property. Success Limited does not make transfer to realize profit in respect of excess depreciation. Let's look at the requirement. Required: A. Prepare extract of Success Limited financial statement for the year ended 31st December 2020. B. State how the accounting treatment will be different if the opening revaluation surplus did not exist. So now let's analyze the question before we jump into the solution. So here we had a value at the beginning of the year to be 400,000 Ghana cedi, and then the useful life that we had was 20 years. Now remember, as I told you, to account for revaluation gain or loss, you need to depreciate the assets up to the date at which the revaluation occurs. So the axis of which date the revaluation occurred. Revaluation occurred on 31st of December of that same year, 2020. So here we need to account for depreciation only for 1 year. So we'll pick the value that we have now, and then we divide by the useful life, which is 20 years. So 400,000 divided by 20 years will give us a depreciation. Here that will be the annual depreciation, that's the 1 year depreciation. Then we will subtract this 1 year depreciation from the value of the property, which is 400,000, to get a carrying value. Now once you have been able to ascertain the carrying value, you now have to compare with the revalued amount, the new value that we have for the property. You have to now compare with it, and here if you get a gain, you know the gain here, you ask yourself, where are you expected to send it? When you get loss, where are you expected to send it? Now without this our question, we are told that we have a revaluation surplus already existing. So it means that previous year we accounted for a revaluation gain, and therefore we still have the balance remaining in this period. So we have been told of the revaluation surplus amount. So yeah, in the case whereby we get a revaluation gain, then the treatment will still be the same. We'll send it to OCI, where we are going to send it to OCI, where this amount will be treated as a revaluation gain, and then we'll transfer it again to the statement of changes in equity. But in the case where we get a revaluation loss, ideally loss should be sent to us statement of profit or loss. But yeah, since the question has made us aware that we had a revaluation surplus in line on 1st January 2020, we need to then send the loss to statements of other comprehensive income up to this value. So you compare the loss to this one, and you send it up to this value. Now once you send it up to this value, to then be transferred to the statement of changes in equity to actually reduce the 80,000, and the remaining will be sent. The remaining will be our closing balance, which we are expected to send to the statement of financial position. Now let's look at how we'll solve it actually. So we are taking the A that's preparing the extras based on all the information given. Okay, so yeah, as I said, we are going to pick the fair value. We'll pick the fair value, then you depreciate it. So here we'll pick the fair value, which we have already established was this, and then we'll depreciate it. And the depreciation, as we said, you pick the 400,000, divide by the useful life, which was 20 years, and that will give us a depreciation of 20,000. We subtract this one from the value of the property, which was 400,000. We get 380,000. Now we have to compare the 380,000 with our revalued amount. We compare with this, our revalued amount. And remember the formula for revalued gain or loss. We have to pick the revalued amount, which is this one. Then you less it with the current value. So here our revalued amount as at this date was 344,000. Then we'll compare with this one to check whether we are going to get a gain or loss. So when we do the comparison, we realize we had a loss rather for that period. We had a loss rather for that period. So when you go to the statement of profit or loss, we are going to show the depreciation for the year. I know depreciation is an expense, so we need to debit it to the statement of profit or loss, and the figure we are going to represent is 20,000. If we move to the statement of other comprehensive income, that's where we are going to show our revaluation loss, because we are having a previous revaluation surplus. So we are going to show our revaluation loss, which is also an expense, so we need to debit it, and the amount we are going to show is 36,000. Then there is a need for us to transfer this revaluation loss to the statement of changes in equity, where we are going to show the changes which has occurred on the revaluation surplus during the period. So we show the revaluation surplus column, where we bring the balance, the opening balance of the revaluation surplus, which per the question we were informed that it was 80,000, and then the loss that we recognize in the OCI, we bring it here as 36,000, so that we can get a closing balance that we need to transfer to the statement of financial position. So we'll send closing balance of 44,000 to the statement of financial position as an equity item. When it comes to the statement of financial position, we'll first show the PP, the carrying value, and the amount that we are expected to show. And as I told you, the revalued amount becomes the new carrying value. So our revalued amount, which was the 344,000, will become the new carrying value of the PPE. Then we also have to show the revaluation surplus, the closing balance, which we established as 44,000. Now let's go to the B. Now if you look at the requirement for the B, we were told that what would have been the accounting treatment if the opening revaluation surplus did not exist. So in the case whereby the opening revaluation surplus did not exist, remember that we are going to send a revaluation loss. We are going to treat it in statement of profit or loss. So here basically the accounting treatment will be different if the opening revaluation surplus did not exist. So this is because according to IAS 16, an initial revaluation loss will be charged to the statement of profit or loss, and this is what we are going to show. So here we show the depreciation first, when we establish that it was 20,000. We show the revaluation loss here as 36,000. Now when we come to the statement of financial position, we only show the value of RPP, and that will end this question. Thank you. If today is your first time here, kindly hit on the subscribe button and now to be notified with our new videos. Catch you. Bye bye.